Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade. But before we do, the required disclaimer material. We would like to let you know that this presentation is for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and please make sure you are aware of all your risks prior to placing any trades. Also note that we'll be using hypothetical computer simulated trades in the presentation. They are believed to be as accurately represented as possible, but keep in mind live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Locke in Your Success LLC, where myself and my team are here to help traders win in the market and in life as well. And today I'm here to guide you into the realm of high probability income trading. Now in a moment, we're going to go over the winning trade, but before we do, let me quickly explain what we mean by an income or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than depending solely on price movement to go in the right direction, meaning that we can often make money whether the price goes up, down, or sideways. Now this doesn't mean we're going to win all the time, but it does mean that the probabilities of us winning are much higher than they might be otherwise. Now, when you find yourself wanting more information as you're following along, simply contact us at lockeinyoursuccess.com or ask a question in the comments on this video, and we can direct you to where you can find more information. The winning trade we're looking at today is called an M3.4u. This is one of our many broken wing butterfly style strategies that we regularly trade on the Russell 2000. This is a fairly simple income strategy that's easy to manage and can be traded with as little as $2,500 per trade. This example size is going to be $5,000. The position does not have a profit target, but in general, I expect a good month to return around 10% of our planned capital, which in this case, on a $5,000 trade would be around $500. And our exit loss trigger on this position is also 10% of our planned capital, or in this example is going to be $500. All right, let's look at the position. All right, so this is what an entry looks like. We enter the position 56 days to expiration, and for our November 15th, 2019 expiration, that puts us at an entry of Friday, September 20th, 2019. For those of you who maybe haven't joined us before, this is a trade matrix. This represents the months of different expiration cycles. These represent the strikes that we are buying or selling on the Russell index. And in this case here, what we do in the case of an M3.4u is we model a 60-40 broken wing butterfly. And if you notice, this is not a 60-40 broken wing butterfly exactly. If I were to take this strike here and subtract it and add it back in here, that would be a 60-40 broken wing butterfly, meaning we have 60 points between our short strikes and our long strikes on the downside, and 40 points between our short strikes and long strikes on the upside. If we do this, our entry delta, and if you don't know what delta is, it's essentially the slope of this curved line here. And it's telling us that we're at positive 3.79. On our entry, we want to be close to delta neutral. So to correct that, we're going to be taking this option here and placing it up higher. And if we were to do that, then that leaves us with almost neutral delta minus 0.3. So we end up with 1480, 1540, 1580 broken wing butterfly, and a 1480, 1540, 1590 broken wing butterfly to bring a composite position that looks like this. And for those of you who may not be familiar with a risk graph, the asset price or the Russell 2000 price is along the bottom, and the profit and loss of the position is over here. We have what's called an expiration graph, where the value of the position at expiration, which is going to be this dark blue line that looks like a triangle, and that'll tell you what the value should be at expiration at any given price point. And then we have what's called a T+0 line, which is this curved red and blue line, and that represents the profit and loss at any given price point today, or at least the projected profit and loss at any given price point today. And as time goes by, this curved line tends to match the shape of the straighter lines. If we're under the tent or near the tent, a lot of times we'll make money. If we get way outside the tent, if we do nothing, we would lose, but as you see, we'll make trade adjustments as time goes along. Now for trade adjustments here, for this size, we are going to adjust this trade when we hit a delta of +4 or a delta of minus 3. And If we cannot correct it easily, we're going to end up rolling the position, or in other words, taking the position off and moving it. So let's just go along here and we'll see how this does. So what we're going to do is it's Friday, September 20th. Let me just pop ahead to the first adjustment. So here we are, Friday, September 27th, and we're sitting here at positive 5 delta. Our maximum is positive 4. So what we're going to do to correct this delta is we're actually going to widen this upper wing, and that's going to give us more negative delta. So I'm going to take this off here. I'm going to move this up here and then see what our resulting delta is. In this case, it went from positive 5 to positive 1. That is acceptable. So let's do that. And this is going to be our new resulting position. So it's Friday, September 27th. If we go to our next adjustment, that's going to be on October 1st. So on October 1st, the market continued to drop. So if we look at our price chart here, we entered up here somewhere, and we've had quite a drop in the marketplace. So at this point, we are at positive 9, which is more than twice what our maximum is. And the good thing about this strategy is we're not going to touch it during the day. We're just going to have a once-a-day adjustment point, and it can go over quite a bit, as you can see, and it's really not that big a deal. So here we are, like I said, at positive 9, and what we're going to do is we're going to take this upper wing, we're going to try and widen it again and see what happens. So if we widen out to a symmetrical butterfly, it brings us to positive 3.7 in our delta, and this is looking good. Now, once we get to this position, the symmetrical butterfly position, we no longer make downside adjustments with this upper wing anymore. If we have another downside adjustment, we're going to take the position off and we're going to move it. And I do think that actually happens here. So it's October 1st. Oh, that didn't take long. October 2nd, we get a continued down move. We're plus 6 delta. We're already a symmetrical butterfly. So what we're going to do is we're going to roll this back. In other words, we're going to just sell the butterfly off, and we're going to reposition back here at, well, we're at 1480. We'll reposition back at 1480. And then we're going to kind of flatten our delta out a little bit. So you can see the position, we took it off, and we came back down here. And we did flatten our delta down a little bit. This time we're maintaining a little bit positive delta. I will generally do that when we're getting pushed to the downside because normally the market bounces. Not all the time, but normally. So a lot of times we will definitely stay in trade range, but we'll stay a little bit toward the positive side. And that's what we did here. We rolled back, maintained a little bit of positive delta. So it's October 2nd. Basically nothing happens here until October 11th. So what's that, about nine days? At this point, if you remember right, our maximum negative delta is -3, and we're exceeding that. So to deal with that, we're going to take this here and bring it back down, and that's going to make a correction. So, oh, actually, I made even a bigger correction than that. So what we ended up doing here is I ended up taking this put and bringing it back here to make our correction. But when we did that, our capital level started to get too high. So to correct our capital level, we're going to bring this wing in, and that brings us into a position like this where we're well within our $5,000 capital limit, and we are a relatively flat delta. So let me just clear that off. Actually, let me ignore today's trades. And that gives us our resulting position. So let me clear these. And our new position is here. We're basically 0 delta in this case, and we're looking good. So it's October 11th. Next adjustment is October 15th. Now once I get substantially over this long strike here, so you notice I'm at 1520 right now, Once I get over this long strike, then my delta limit kind of changes from -3 to 0. So here is, we are due for an adjustment, so I'm going to take this upper wing, I'm going to narrow it down some more. And we end up in a position like this, and that gives us, in this case, +2 delta. So this looks good. Let's move on. We go a few more days, and again, we're starting to push just maybe a little bit negative delta here. So I come in and I make an adjustment, and I do kind of the same thing where I'm going to move this down. And for me, this is too much of a shift. Plus the capital level gets a little bit high. Anytime we get near that 5,000, we're going to knock it back. And I can come into here. So I'm still relatively flat delta, but I'm a little bit positive now. Some of my downside risk is off the table, and I've increased my potential win here to the upside slightly. So that's how we deal with that. Let me erase this and let that happen. And here is our new position going forward. So from a price chart standard, we came down quite a bit. We had to do some down adjustments. We had to roll back. And now we're having the common thing that happens after that, which is a fairly substantial up run. It looks like it's going to continue to go higher here. So let's move forward here to the next adjustment, which is the 21st. Again, we start to pull in a little bit negative delta. So we're going to take this option, we're going to bring it down to 1,500. And this is our new position here. On this strategy here, if that's a little bit too much of an adjustment for you, you can look at actually rolling this one in too, which arguably may have been a good idea on this particular case. Certainly gives you a lot less downside risk if you're concerned about that. You could also even do one. That would be very acceptable there as well. But this is where we ended up, which is within limits, which is fine. We go to the following day here. Still looking good. And let's just go to our next adjustment point here. So what happened here is the market ended up going up quite a bit. So what I did here is we're getting negative delta again. So again, we want to look at rolling this back. When I do that, again, I get a lot more in the trade than I might want to. So what I end up doing is also bringing this higher. Something like that. So let's let that happen. And now I have pretty much just slightly positive delta, but here is our new position. If I go to the next day, again, I'm pushing in a little bit more negative delta, and this is the final adjustment. This does have an adjustment limit. This is as far as we go to the upside. That's maximally adjusted. Let's let that happen. And from there, we got a bit of a down move. And let's just go to the end here. This is going to be our exit day. So we can bring this all the way to expiration, and we would actually expire this. We'd let this go. We wouldn't trade out of it. But in the software, we have to trade out of it. So we would trade out of this here at a profit of about $381. Or let's see, in this case, that's going to be somewhere in the 8% range, which is pretty much what we tend to expect on these when things go fairly well, which they did here. And that was the M3.4u trading strategy, this episode's winning trade. If you like what you see, I encourage you to join us and discover how you too can follow along with this and many other great trading strategies as they unfold during our weekly Options Trading for Income webinars. And we can also learn about upcoming winning trade presentations, and perhaps best of all, you can get information on our free Trading Performance podcast, where you can learn how to become much more effective as a trader, regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see in the next winning trade, we'd love to hear from you. Simply comment on this video below so we can get those answered for you. And we would also encourage you to come on over to thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as a lot of other fantastic bonus information on how to profit through income trading. And please remember to subscribe and comment on our YouTube channel, where I can personally answer any questions that you may have. Thank you, and we'll see you on the next winning trade.